Well, I think it's time to panic. I think it's time to become very, very panicked. The stock market is going down. If we read the headlines, it looks pretty bad. We're scratching our heads here. We have lots of red on the screen. The Dow Jones is down 1.37%. The S&P 500 is down 1.83%. And then the Nasdaq's down 2.38%. I don't like to see that. That's a lot. 2.5%, that's quite a bit. It looks like tech companies are not the place to be right now. And we also have some more scary news. It's going on just today. Janet Yellen says that the Treasury could exhaust its cash reserves by October 18th if the debt limit isn't raised. This is a constant struggle that the US has. We spend more money than we make, and then we have this artificial barrier called the debt limit. This is like the credit card limit where they say, hey, we're not going to loan you any more money because you're not paying us back. But then as the US, we have the magical power of raising that debt limit. We can just push it up a little bit further so we can take out more debt. It's something great that we're able to do. Now, right now, Congress is arguing over this, which they do every single time they face a debt limit. The Republicans don't want to raise it, and the Democrats want to raise it. They'll make a big kerfluffle around it, and then they'll eventually raise it. But this, nonetheless, is also occupying some of the news today. But here is the worst news of the day for tech stocks. This is the scariest number that we can see. The US Treasury has hit 1.5%. It's gone all the way up to 1.5%. Now, keep in mind that the historical average for like the last 100 years is way above 3%, but right now 1.5% is a spike. Now, my portfolio, of course, is no exception. If I look just today, I'm down 1.56%. That's $4,800. It's a lot of money to be down in one day. And we can look at the industries that are getting hurt and the ones that are surviving this a little bit better. The worst category is the tech and cloud computing. I have two of the big giants here, Apple and Microsoft. Both of them are down today. Apple's doing a little bit better than Microsoft currently. And then I have IGV that targets much smaller tech software companies. This is down quite a bit, 2.87%. So this one's struggling a lot as of right now as well. In consumer, none of these companies are doing good today. All of them are in the red. In real estate, no real estate company is doing well, except for some reason Simon Property. That one's in the green currently by 0.01%. It seems like Simon Property likes to just play jokes on us. It's the mall REIT. It's supposedly the lowest quality one, but on days like today, it's in the green. We can take a look at the income funds. I'm down 1% in SCHD. That's better than the overall market. And then I'm down 1.43% in JEPI currently. Then in the banking category, we have JP Morgan. Even JP Morgan is in the red when there's fears of interest rates spiking, which is very odd because banks are supposed to be some of the companies and equities that are beneficial from an interest rate hike. And of course, we have Visa, MasterCard, and T. Rowe all in the red heavily at this point. T. Rowe has been hit very hard recently, but I am still holding on to this company. We can take a look at healthcare. These companies are doing much better. But granted, I have two of the most boring, profitable, value healthcare companies in existence with AbbVie and Johnson & Johnson. And AbbVie is one of the few companies in my portfolio right now that is in the green. The renewable category, we have Dominion Energy and NextEra, both in the red by over 1%. And then in the restaurant category, we can take a look at Texas Roadhouse. It's down 1.1%. So looking over my portfolio and the one-day performance of it, what can I learn from this? Well, the honest truth is not much. Not much other than the fact that's always been a fact that the stock market goes down sometimes, and that's okay. And it's not a problem. It's not a problem when the stock market goes down. It's normal. You don't have to solve anything. You don't have to change anything with your portfolio. In fact, in most cases, it's better if you do nothing. If you sit there and do nothing with your portfolio, you'll likely have a better outcome than if you try to rearrange everything and you try to figure out what's going on with the falling stock market. If you're anything like me, the most difficult thing to do in situations like this is nothing. That is the most difficult course of action, even though we know it's probably the best course of action. Having the self-control and the restraint to not do anything when there seems like there's a glaring problem with your finances is something very difficult to do. But this is not a problem. Even though it looks like a problem that needs to be solved and you need to solve it, the stock market going down is not a problem and it's not abnormal. If you ever want validation of the stock market going down not being a problem, just zoom out a little bit. When I go back to all time, I'm in the green by $54,000. And the reason I've got this far is by holding on to great companies that grow their earnings over time. That's all I've done. If you're going to try to solve the problem of what to do when the stock market has days like today, you're going to have a lot of trouble. You're going to have a very difficult time. Because first of all, today's like today are normal. This is a normal sell-off. This is something that happens continually and frequently all throughout the history of the stock market. Every single company is down a little bit because interest rates are going up. If you look at this tree map of the S&P 500, you can see that there's no real safe place to hide when this happens. I guess you could target the energy sector if you wanted to do day trading and reposition your portfolio and try at a time when commodities and energy are going to trade up and when these other companies like the tech companies are going to trade down. But that is a trader's mentality. That is something very difficult to pull off. For most people, you're going to have a very difficult time making money trying to trade in and out of different sectors, timing their gains and losses. An easier course of action, and one that's been proven to actually make gains for the majority of people, is to buy high quality, profitable companies that you have very high confidence that those companies will grow their earnings over time. That's how you make money in the long term with the stock market. You buy companies and you hold on to them while they grow their earnings over time. Peter Lynch has emphasized this very point his entire career, that stocks are not lottery tickets.
I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated.
These stocks are not lottery tickets. They're businesses that earn money. And like Peter Lynch points out, if they earn more money in the future, in 5 to 10 years, they're going to be worth significantly more money in line with the amount of money that they're earning. If their EPS grows, so will the stock price. That's typically what happens. Apple and Microsoft continue to grow in market cap because their EPS continues to grow. They're earning a lot more money today than they were 5 years ago. Costco is one of the best examples of this. The annualized return of Costco since 1995 is 17.68% with dividends reinvested, whereas the S&P 500 is 10%. The reason that Costco's annualized return is higher than the S&P 500 is because over this time period, Costco has grown their earnings per share around 17%, while SPY, the S&P 500, has grown theirs around 10%. Both of them have roughly followed their earnings growth. This isn't rocket science. Companies will be worth more in the future if they grow their earnings. These day-to-day trades really have nothing to do with their overall future. So to answer the question, what do we do today during this market sell-off? The answer is likely nothing. That is likely the best course of action. And if you really feel the urge that you must do something with your portfolio and with your stocks, likely the best option is to deploy a little bit of cash into a company that you've been wanting to buy. But other than that, I really believe that for most people, doing nothing on days like today is the best option. And that's all for today. I'll have another video out this week. Until then, I'll see you next time.